Hi and welcome to Swissquote's Daily Market Talk. It's April Fool's Day, or the day before the Liberation Day, if you will. Investors are tense, appetite is limited, the US dollar swings between gains and losses, indices around the world are under pressure, gold trends higher, while crude oil's Monday rally could attract some top sellers in this unsupportive global setup for trade and growth. So March is over. The pain is probably not. Global equity markets kicked off the week on a negative note yesterday ahead of the so-called Liberation Day on April 2nd, the day the Trump administration will reveal the reciprocal tariffs to the rest of the world. Now, I personally think that April's Fool would have been a more suitable date probably to reveal whatever will be revealed tomorrow, as based on the strategy adopted by the White House since the beginning of Donald Trump's second term as the President of the United States, tomorrow's tariff announcement will likely be exaggerated, overdone, buzzy, and nerve-wracking to make the others fear, react, and negotiate. So that's probably why you see investors around the world quite edgy before tomorrow's tariff announcement from the US. The SOX 600 index in this context tanked 1.5% at yesterday's trading session. The S&P 500 gapped lower, although the index somehow managed to rebound from the March 13 low levels to close yesterday's trading session some 0.55% higher, while the Nasdaq 100 index fell to the lowest level since September last year before closing near flat. As such, both the S&P 500 and Nasdaq 100 posted their worst quarterly performance in about 2 years, as the high valuations in the US stocks, especially the high technology valuations, came down during the first quarter of this year, and capital flew into the non-technology and non-US pockets of the market. Invesco's S&P Low Volatility Index, for example, that includes quite boring but low volatility names like Coca-Cola and P&G, gained 1.36% yesterday and is up by almost 7% since the beginning of the year, which is not bad for low volatility stocks. Whereas the SOX 600 index gained more than 10% at some point last quarter, by the beginning of March exactly, yet shed almost half of these gains as the narrative for Europe went from the jump in government spending, especially from Germany, will boost growth in the Eurozone, to tariffs will hit earnings. Now note that the index, the SOX 600 index, slipped below its major 38.2% Fibonacci retracement on the year-to-date rally yesterday into the bearish consolidation zone, hinting that the sell-off here could continue, and the market narrative of the moment would be supportive of a further retreat in the European stock prices unless the Europeans shift their focus and the rhetoric back to growth that the turmoil will offer the old continent. In Japan, the Nikkei remains under pressure as well this morning, as the car makers there are also quite skeptical about what the tariff day will bring on the table. Interestingly though, the British FTSE 100 index seems to be weathering the tariff sell-off somehow better than its major peers in Europe. The index actually posted some 5% gains in the first quarter of this year, and that's its best performance since the end of 2022. But here as well, the index tested the major 38.2% Fibonacci support yesterday, pointing that it's also on the verge of falling into a medium-term bearish consolidation zone in this uncertain and unappetizing setup. So from here, there are basically many possible scenarios, obviously, but the most likely two are: 1, the tariffs sound more reasonable than many investors feared, and global indices rebound with a certain relief until the next tantrum. Or two, the tariffs on the tariff day are unreasonable, like the 200% levies, for example, that Donald Trump threatened the European alcoholic beverage makers, for example, earlier this year, and the world is pushed into a deeper chaos in terms of trade and international growth situation. So the majority of investors appear to be pricing the second scenario right now as gold prices continue their journey to the north with little hesitation from investors who are trying to hide from the chaotic situation of the market right now. The price of an ounce of gold is trading above the $31.40 level this morning, and the dollar franc resists into the 0.8850 level, which is a touch above its 200-day moving average. Elsewhere, the US dollar's tentative to recover losses yesterday remained quite weak as the index posted a fifth session of lower lows and lower highs, confirming that sentiment toward the US dollar remains comfortably bearish into Liberation Day. The euro dollar was bid below the 108 psychological level. The Italian CPI update came in higher than expected yesterday for the March preliminary figures, while inflationary pressures in Germany seem to have eased in March. The Eurozone aggregate data is due later this morning, mind you, and is expected to have ease in March toward the European Central Bank's 2% monetary policy target. So the lower the inflation print in the Eurozone, the higher the European Central Bank's policy support to the Eurozone economy. And this time last year, soft-looking inflation data would have actually weighed on the euro due to the expectation of lower rates from the European Central Bank. But right now, the pricing in the FX is strongly influenced by relative growth expectations. Hence, a soft CPI update from the Eurozone today would give the European Central Bank enough room or more room to support the European economies, and the latter reasoning would support the euro's valuation. So fingers crossed for the CPI update. That's going to be quite well in my opinion. Across the channel, cable is waiting in ambush below the 130 level, and a further retreat in the US dollar around the world would push the pair above that critical 1.30 psychological resistance, while in Japan, the dollar yen is back below the 150 psychological mark. Now, the pair couldn't clear the critical 151-151.50 resistance zone, including the 50-day moving average and the major 38.2% Fibonacci retracement on the year-to-date retreat. And even though the Bank of Japan expectations softened recently due to the tariff uncertainty, policymakers' willingness there to support the Japanese economy and keep inflation going, and the dollar's broad-based weakness actually keep the outlook in favor of the Japanese yen against the US dollar. While we are in Asia, the latest Caixin manufacturing PMI data hinted that manufacturing in China grew faster than expected by analysts in March, pointing that the Chinese government's efforts to boost production in China may be paying off. Now, the CSI 300 index is offered this morning into the 50-day moving average, but the Hang Seng index in Hong Kong is up by around 0.56% at the time of talking here, as the technology giants from China, including Alibaba and Tencent, are better bid today after an ugly Monday session. In Australia, the Reserve Bank of Australia kept its cash rate unchanged today, as broadly expected by analysts. That and good news from China, and also its broad-based US dollar weakness across the board, gives support to the Aussie dollar this morning. But note that the gloomy global growth outlook will likely keep the upside limited for the Aussie bulls. And speaking of that, speaking of global growth, crude oil bulls brushed off the waning global growth outlook by the possibility of lower Russian and Iranian oil supply. So crude oil jumped nearly 3.5% at yesterday's trading session, and clearing the critical $70 per barrel resistance, and the 50-day moving average gave a further support to the bulls yesterday, and the price of a barrel of US crude is presently pushing above its critical 38.2% Fibonacci retracement level. Now, in theory, a break above this level should send the price of US crude into a medium-term positive trend, into the medium-term bullish consolidation zone, and support a further rebound. But at this point in time, it's quite difficult to give a bullish call for oil when the international trade context remains so strongly unsupportive of a medium-term bullish reversal. So this is all for today. Fingers are crossed. I'm İpek Özkardışkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow for Liberation Day. Well, it's not going to be anything new because the day is going to be after my show, but still, I'll meet you tomorrow. And until then, good day trading.